Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, November 10th, 2022. Let me center this chart. We're going to start out here with treasuries and then talk about the equity markets. I want to get it out to you quick because I think we have an opportunity right now, very objective shorting opportunity. We already had one today, quick pullback trade on this pop up, and we'll probably have one that's going to give us a little bit more juice, another pullback. But first of all, ZB, treasury bonds. This is pretty obviously been one of my most consistent or favorite, swing trades, both on a short-term time frame. I laid out these near-term targets on Tuesday. We were still in the wedge. Breakout looked imminent. We broke out. We hit the first target right here. Hit the top of the zone. Blasted right through. As I said, this trend line here, this is our primary trend line today. And let me be very clear, I remain intermediate term bullish. I think we'll probably get a pullback. This is probably a brief momentum overshoot, and I would look to buy dips on pullbacks or sit tight. Like I said, if you're not an active trader, active traders, if you trade futures, that's one of the biggest up moves in treasuries in a 2-day period. We've seen in probably years, especially since around COVID when things were real volatile. So you either take the quick buck or hold on. Let me show you the bigger picture, and that is I've been using the word repeatedly: explosive rally in Treasury bonds. If and when the trend line on the 30-year yield was taken out, that's it right here. So we took it out, and so to me, it's a matter of will they just continue to press it and run right all the way down to my target, or what I think will probably get a little kickback in yields, which is a little pullback in bonds, and then get down there. Like I said, we spent a lot of energy just to get up here today, but that is, make no mistake about it, there's the all-in buy signal I was looking for. We just, like I said, pop big today. Treasuries are up. The futures are up 3.21 on ZB right now. I can't ever recall in quite a while where they've been up that much in a single day. And TLT, there it is. So that's a breakout all day long and then some. And it's just a matter of you want to try to game a pullback to back test the trend line. There's a big old gap there if we happen to come shoot in a little more, or just sit tight and hold off. Bonds are to me, again, the best risk reward profile, much better than the equity market, which I'm about to get to in a second, despite today's healthy gain in the stock market. The RR, meaning risk reward profile, is just still better. But again, you have some resistance here. You look at TLT right now on the daily. I'll just throw that line up there. So we broke out. Again, we've spent a lot of fuel. A 3.12% move in treasuries is one of the biggest daily gains in years, maybe even in history in treasuries. But that's the term. It's expecting an explosive rally because it was such a well-defined trend line, and it took one little catalyst. I didn't parse through all the information, but I heard inflation eased to 7.7%. I told you this whole bear market's going to be a roller coaster of rallies with little abatements in the market's expectation and true abatements in the inflation numbers. But we're going to have, I believe, a persistent inflationary environment for some time to come, and then the market's going to just rally when it looks like they think inflation might be over. But 7.7% headline number is better than expected, but certainly not certainly doesn't mean inflation's over. So so therefore, like I said, we've probably seen most of the pop for today, if not all of it. And I'm gonna get to the equity markets in a second. And longer term, because of this trend line break, that's still 100.63 in TLT, and then ultimately possibly all the way up here to 108. Still plenty of upside left, but for today, like I said, it's prudent to take. There it is. You can see on the 60-minute chart. There's the same primary downtrend line on TLT, but you can see the resistance even better here, about 97.95. So that's that. And let's talk stocks real quick. NQ. I'm going to go. These are the 6-month. This is a 6-month chart, 2-hour candles. Please ignore all these DHs, divergent high and divergent lows. This charting platform bugs the heck out of me, but any annotations, and you put any text annotations you put on there will carry over into all time frames, and so these are from my 60-minute chart. But what I wanted to point out, the most important thing, and this is what I got out to you this morning, there's our primary downtrend line off the August highs, the mid-August highs. That was a major reaction high right there, end of a bear market rally. So it's very technically significant, and we have quite a few reactions, and we're there now. Technically, we're a hair over it, but when you get an explosive move like this, it's almost a guarantee. I'd put it close to 100% that you're going to get what I call, term I came up with years ago called a momentum fueled overshoot. You know, and it's when you have tremendous momentum or velocity. I always use the analogy of a pitcher throwing a 100-mile-an-hour fastball. It's going to hit the catcher's glove. It's not going to stop there. The catcher's glove's going to snap back. His wrist will snap back, and then come back forward again. And that's the same thing you see with the technical levels when you have, a near vertical thrust up. When you zigzag your way and you work your way to resistance, that's when you usually get the nice clean reversal off the resistance level. So look, can it be a breakout that keeps going? Yes, but extremely unlikely. The future's up 5.5% right now. That's about a limit. It's not lock limit on them, but it's about what you see in a day. And more importantly, you have some key Fibonacci's here. This is the blue line here. 38.2% to the button right there, and I'm talking of that move down, the same trend line, the same drop off the mid-August highs. We are at a key Fibonacci retracement level, as well as price resistance there. And not only that, but you also have it on ES right here. This is the same thing, 6 month, 2-hour candlesticks, mid-August high right there. There's your trend line. We did pop it. I'm going to give it that by a pretty fair margin. But again, if we're going to hold that breakout, at best we're going to come back and back test, and that would be a pretty decent pullback trade. So that's what I'm pitching here right now. One of two things. At minimum, another pullback trade. We got one this morning. I'll get to that. We hit that 1%. It was a little better than 1% at the open when I got out to you. And then I think we'll get one more that's going to be bigger today. And so right now, as I'm doing the video, this is where it's my kind of all-in short moment right here. 39.22, give or take. That is the 50% Fibonacci retracement as well. So you have not one major index, the two big ones for me, the ones that I follow, the S&P 500 and the NASDAQ 100. As I always say, the Dow is only 30 stocks. It's antiquated, it's old school. Someday they just need to get rid of it, but I guess Dow Jones makes too much on marketing rights and all that, and it was back in the day, it was, the original index, if you will, for the U.S. stock market. So people still quote the Dow, but 30 stocks is not very representative of the entire stock market or economy. But so the S&P 500 does a better job, and then the NASDAQ 100 just concentrates it into what really moves the market, and that's tech. And that's why I trade that. But there it is, a beautiful dual fib retracements on the major indexes, and spent a lot of fuel to get up there today. Here's a downtrend line. So this whole thing, if you look at the downtrend line right there, I mean, there's an uptrend line off the low, and ES, again, these are the S&P 500 futures. That's a symmetrical triangle. So bull case wants to see maybe a pullback to the trend line. That would be healthy to clear out some of the near-term overbought conditions, and then power on up through price resistance and that fib, and then head up to the next one. And that's still very much a possibility. Obviously, look, let's just call a spade here. The facts go, or the odds go up today that we could go up and run at and hit those bear market rally targets, the 200-day moving averages and or the primary trend line again on SPY. That's the trend line off the all-time high. Right now, remember, I'm focusing on the mid-August trend line in the futures, stock futures, not here on SPY. You don't see it as well. But you do have a trend line you can see on QQQ on the daily chart. Busy chart here, but I'll show you the trend line right here off that mid-August highs. You can see it on QQQ. We're there. So I've got plenty of resistance here. on the Qs and SPY, and we know we're very very near term overbought, and I wouldn't be surprised to see a powerful reversal today, and that's what I'm so. Whereas on the open, I got that chart out to you on the futures. I screenshot them just before the open to try to get it out to you in time for the open. There was a fade. If you faded the open, you got that 1%. I was looking for at least a 1% pullback. It was 1.12, 1.13, and then we thrust up one more time. Buyer stepped in. Those that faded the gap probably covered there. You're looking for a quick, gap fade when you get a gap up that big. But the next one down would probably exceed that, is my guess here. So we'll see. We'll see how the day finishes. Remember, it's a pretty powerful buy signal in Treasury bonds. They've continued. Well, the correlation lately, like I said, I felt very comfortable with them because we started to shift to risk off, where even days the stock market was down recently, treasuries were doing okay. Now today they're both rallying. And again, I always say this, trade each security on its own technicals. You can't rely on old correlations or historic correlations, especially when they're kind of spotty. So right now, like I said, no mistake about it, the longer term, intermediate term really outlook for treasuries is bullish. So if you want to get very technical, micro short term, I think we're a little stretched, probably get a little pullback, a little consolidation at least. Possibly not, because again, the term I've been using for a while, explosive rally. So we could just continue to go up there. Probably a ton of shorts in the treasury market getting squeezed out right now. That was a clear breakout. But again, favoring a little pullback, but intermediate term bullish, meaning more upside in the coming weeks, maybe even months. Max target up there, again, a maximum target. We may not get there, maybe only there. We'll see. I'll let you know as it goes. But then longer term bearish, when you look back at remember, treasury yields and bond prices move inverse. I was just showing you TLT, but this is the longest term chart that I have. This is a monthly chart. I can track these yields back into the 70s. Think Jimmy Carter, Reagan coming in office here, end of hyperinflationary environment, last comparable environment we have to now. That's where it ended, and we entered a secular bear market in interest rates, meaning there were plenty of bull markets along the way, but the whole trend was bearish. And by every metric, check, check, check. When you start taking out previous highs, you start, and most importantly, take out a well-defined downtrend line. It was really a price channel we were in all those years for 40-something years, and then these little bouts of quantitative easing, and then the all-out nuclear option, the Fed took it out here and kind of just boom, and then that's what started this hyperinflationary environment we're in, and sent bond yields soaring. So they've taken out everything. They've taken out the previous highs. They've taken out the trend line. So when you want to, if you ask me my longer term outlook, yes, I'm still very bearish on bonds. I think they'll be one of the worst investments in over the next decade or so. Not as bad as here. Here I said you had absolutely no benefit to treasuries, because if you, at best case scenario, even back here, if you're 401k, you're a bond investor, at best scenario, interest rates would have stayed near zero on the floor, and you would have collected paltry interest, 1% a year, a little over 1% a year. This is the yield right here, 1%, 1.2, 1.4. So you had virtually no upside and all downside, because interest rates had nowhere to go but up, and so then that's why you saw the biggest drop in bonds and pretty much I don't know if it'll go down in history over such a short period of time. Yes, I believe. Anywho, so that's it. So at best case, this is kind of my bigger longer term outlook. So what we could see here, you've got a trend line working off the lows, and then you have your primary uptrend line. So this abatement in yields right here, a drop in yields would be a rallying bond. So that's what puts me intermediate term bullish for bonds, but still longer term bearish, because if we had a pullback all the way there, there's a nice reaction high in yields, that bonds would rally, but then can resume their uptrend. And we're going to start, believe we've started a new secular bull market in rates. And that's what's also going to put pressure on equities. And going back to the equity markets, remember, everything I said yesterday, back we're in a bear market, none of the metrics have changed. We're still off those lows. And so now, we're zigzagging up. But look, let's turn off all the lines for a second. So despite the vigor of today's rally, it's just a lot of short interest being squeezed out in this market and a lot of hopium. That's been being served up, I told you, on TV like I've never seen. They're just marching out the bull parade lately, seasonality and midterms and all this other stuff. But, from a technical perspective, look, everything is still in place. The bullish engulfing candles, lower lows, but so far we haven't taken out the previous highs. Remember, this is big resistance right here on QQQ. Not just the previous reaction high, but we had several candles up around that level. So today, technically nothing has changed. If you want to do the play-by-play call, yeah, when you're up this much, you're farther from the bottom, so the market's in less of a precarious position. So, you can't spin a 5.5% up day as anything, but bullish for today. But more importantly, what I'm trying to say is nothing technically has changed on the longer term charts here, the daily and the weekly charts. Like I said, we're still, we start to take out this level about 285 on QQQ. Yeah, things start to change. It's not a complete, hey, we're going to go to new highs in the market, but it's going to open the door to a run at those 200 days. They're still way up here, the 200-day moving averages. But I don't think we're going to get there. That's my take. I'm telling you right now on a 5.5% up day that I'm shorting hard here. There's another resistance level on SPY right here. You can see it clearly. I'm just draw it out for you. This whole line right here goes back. It was a major defense right here, major lows. We rallied, had a nice bear market rally. Once we took it out, we got rejected when we tried to take it back here, so that helps validate that as an important level. Then we had a breakout above it right here. There's your breakout, followed by, you got it, a successful back test. That's another check mark. That's how I look. That's how I analyze charts. That's how I identify support and resistance levels. The more reactions, the more valid it is, the more important it is, the more eyes see that level. There's another back test. Boom, they bought it. Then came back, tested again here, broke down. They rallied back, tried to gain it, got rejected, smacked down at the line twice, and then the bottom fell out. Went up here, got rejected again, so we're here now. So again, on SPY, remember I showed you a comparable level on QQQ, which is quite a bit higher, but SPY, I got to give them this. If SPY can power through here and close the week, I want to see a weekly close solidly above that level. Yeah, that's a check mark for SPY. But as of now, I will take in a bear market a 5. Well, SPY is only up 4.17. I will take a 4% rally into resistance all day long, even as a short pullback trade. And I'll tell you my strategy here. Short it and kind of see how the day goes. And, the buyers will step in on pullbacks if we get it, but I'm more apt to just kind of let those run for right now. And I'm thinking we'll see, but I'm suspecting we're going to see some big programs, sell programs hit today. Nothing's changed in the macro picture. All these big layoffs being announced recently from Amazon and Meta, and the trend is clear where things are going. And so again, it's a little overdone. But unless these bullish engulfing candles are wiped out, you've really, any move like this, even though it's at resistance, increases the odds you're going to run at the 200 days. And remember, your primary downtrend line, that's all, I drew that as a mess, but here's your primary trend line off the all-time highs in the S&P 500. It's nice and clean, a lot of distinct reactions, and again, that would be a very, likely bear market target. It's what I laid out back here, and it would only be just that unless we take that out by quite a bit, and then you have to take out that previous reaction high. Other than that, this is what a downtrend looks like: lower lows and lower highs. So we'll see. Let's see how the day finishes. Let's see where we go, and I'll certainly do another update at the end of today. But as of now, like I said, just nice resistance. These are levels I've had here for a while, and I've harped on a while. 390, it's always been a big level for me on SPY. And remember, we just broke down from this 60-minute rising wedge, bearish rising wedge with negative divergences, hit that level, and we're just back testing the breakdown point now. So again, to me, it's what I call a heavy short. I'll decide how much of that to take home or how much to close out today, if anything. That's where we're at. And oh, and then if you want to kind of micro zoom down to the short-term time frame, we have, my, kind of my, to hone down my entries and exits for timing, I like to use this 5-minute chart. So we have, you can see I drew it out here right before the video, negative divergence. It's not a lot, but it doesn't take much on a run like this. Negative divergence on a 5-minute chart. So that's why I laid on the shorts pretty heavy here. That 5 minutes on both NQ, which we're looking at here. Here, I'll tell you what, you probably can't even see it on the video. You zoom in nice and tight. There, you can see the divergence lines, and this one would be like this. That'd be your price divergence and the indicators down below. And then ES, and I will wrap the video up and get it out to you since things are moving fast today. ES. Go down to a 5-minute chart. Here we go. And there it is. Let's zoom in a little tighter for you, and you can see. So there's your little 5-minute divergent high, and more importantly is the bigger picture, what I showed you out on the 60-minute and even daily charts. So, all right, let me wrap the video up. I'll get it out to you guys. Still liking the other risk-off assets, gold, treasuries, and as far as swing trading, really nothing's changed there. Gold's still looking good. Treasury's still looking good. Maybe everything might just have a little pullback with the stock market today, would be my guess. I'd be a buyer of gold and treasuries and silver on a pullback. Maybe the market's not yet decided. I'll let you know later on today. All right, this has been Randy Finney with Right Side of the Chart, and have a great day.